talk about the OBBBA highlights. That stands for, you've all heard this millions of times, the One Big Beautiful Bill Act, which is the big tax bill that was just passed recently. So, Aaron, if you could flip me to the next slide. Okay, so I'm going to not go exactly in the order these are going to come up. I'm going to change the order because I'm going to push two of them to the back because they're a little more complex and probably don't affect quite as many of you. So, first of all, the acronym SALT that you see as the first section are the state and local income tax provisions, which in the bill that passed, the TJCA bill that passed in 2017, it limited our deductions, our itemized deductions for state and local taxes to 10,000, no matter how much you had in property taxes, personal property taxes, and state income taxes. And for people that are in the high tax states like California in particular, that really dropped a lot of deduction off of their return. And so in this bill, and this will take effect this year in 2025, the SALT deduction is raised from 10,000 up to 40,000. So that will be very positive for most of our clients. We're being limited in that category. And so this will be a positive thing that takes effect. And then from 2025 through 2029, that's going to increase by 1% per year. And then after 29, it's supposed to revert again to 10,000 unless there's a new bill that does differently. So that's the SALT deduction. The standard deductions, as those of you who have stopped itemizing because they were raised to a high level, this new bill is going to slightly increase them further. So the $30,000 standard deduction for married filing joint couple. This doesn't. We're going to talk about people that are over age 65 in a second because they get some extra amounts. The 30,000 is going to go up to 31,500, just a small increase. These were going to start in 2025. And there's right now, I don't think there's any date that's going to sunset. The head of household is going to go up slightly from 22,500 to 23,625. And the single taxpayers and married filing separate will go up from 15,000 to 15,750. So not a big increase, but a small increase to the standard deduction. For seniors, they're going to be eligible for an additional 6,000 per person. So if it's a married filing joint and they're both over age 65, on top of that 31,500, they're going to get another 12,000 of standard deduction. So this may cause, clients, particularly seniors that are married and both seniors, that they may not be able to itemize anymore because the standard may be larger. And this bill also permanently repealed the personal exemption that we used to get for dependents. That's no longer there at all. Okay, the next thing with the qualified small business stock, I'm going to save for the end. I'm going to do that with the qualified opportunity zones. But the tax rates, there really was no change to the tax rates. The top bracket is still going to be 37%. They did not lower that. It's going to continue to be inflation adjusted as it has been. And so really the news there is that there wasn't any change. Then we have the alternative minimum tax. And as you remember, when they passed the TJCA Act in 2017, they changed the calculation dramatically for alternative minimum tax. They introduced these very large exemptions, and it took, there were really millions of taxpayers who were paying alternative minimum tax just because they had a lot of miscellaneous deductions or a lot of state and local taxes. or they had preference income from other sources. And when they changed it, that really eliminated that for the vast majority of taxpayers. What they've done in the new bill is that they're going to, and this starts in 2026. They're going to have an exemption phase out that's going to start for high earners over $1 million. They're going to phase out the exemption so that people that are higher earning, much higher earning earners are more likely to be impacted by AMT. It's not going to probably have much of any impact for people whose income is below $1 million. So that's going to affect a very small number of our clients. On the next slide, we're going to come back for that qualified small business stock, and I'm going to also skip the qualified opportunity zone for now, and talk about first the charitable deductions. So there were not any large changes. The changes basically were that people that do not itemize, so this would include, for example, the people that I just talked about, maybe the seniors who, because of this larger exemption that they're going to get, or standard deduction rather, they're going to get, who all of a sudden don't itemize. You're going to be allowed for a single taxpayer to deduct $1,000 of your charitable deductions above the line, and you'll be allowed to deduct $2,000 for a married filing joint of your charitable, so that if you are no longer itemizing, you may still be able to deduct a little bit of your charitable deductions. It permanently extended the 60% of adjusted gross income limitation for cash donations, so that did not really change what was going on there. The other new thing they introduced is that it's imposing now, if you're itemizing and you're claiming charitable contributions, they are going to take away a very, very small amount of that. They're going to make you take 0.5% of what your adjusted gross income is, and that amount now is going to be subtracted off of your charitable contribution. So to illustrate that, if your adjusted gross income, let's say, is 400,000, you multiply that by 0.5%, which is 2,000, and if you're itemizing, whatever your deduction, whatever your, this is just for charitable. They're going to take away then 2,000 of your charitable deduction for that year, because that's 0.5% of your AGI. So that's something like they've never had anything quite like that in the code before. So that's going to cause a lot of confusion for people. And it doesn't, I didn't say, I'm not sure if that starts this year. I think it starts in 2026, but it may start this year. Then the next category was, what have they done with itemized deductions? And here the main thing that they did is for people who are in the high tax bracket, which is the 37% bracket, if that happens to be where you are, and that kicks in at various levels, but you have to have a pretty high taxable income to be in the 37% bracket. But if you are, instead of your itemized deductions being able to get you a 37% savings, it's now going to be a 35% savings. So that's another very complicated calculation that you have to do to take away, to not base your deductions on your tax bracket, but instead lower it to only a 35% benefit. So that will actually make higher income people pay a little bit more. Okay. So then the next category, and these are really brand new items that came up. I know that you can speculate on what all the different motivations were for this, but I know this will be well received by the people who get tips in their job. And what they ended up, there was a lot of talk about they weren't going to tax tips at all, and it was going back and forth. So the final bill allows a deduction of up to 25,000 for the tips that are included in your W-2 by your employer. But this is only going to apply to occupations that traditionally and customarily receive tips, and that has not been defined yet. It's going to be decided by the Treasury Secretary. So we don't know yet what that means. I'm sure that includes, for example, waitresses and waiters, probably taxi drivers, but occupations that traditionally get tips. And those tips are reported on your W-2, so it's being included in your income. And then you get to deduct up to 25,000 of that off of it. So anyway, that's going to be another complex area of the law. And this takes effect this year, 2025. And it only goes, according to the bill, through 2028. And after that, I don't know. I think it's supposed to end after that unless it's extended by Congress. Also, I should mention that if somebody has tips, but their income is high for a single taxpayer over 150,000 or married filing joint over 300,000, this deduction starts to phase out. So if you're a high earner and you get tips, you may not get to take this deduction, but people that are single taxpayers below 150 will get to take that. Okay, so, and then the other thing that there was a lot of talk about is not taxing overtime. And what they ended up settling on that is that it's going to allow a deduction for overtime pay that someone receives up to $12,500 for a single taxpayer or $25,000 for married filing joint. This deduction that and it doesn't say here whether that also starts this year. I have a feeling that may start next year, but I'm not 100% sure. But this deduction also phases out at 150,000 for a single taxpayer and 300,000 for married filing joint. So if you get overtime, but you're a real high earner, you're not going to be able to get this deduction. The next thing on the list is credits, and most of the news in credits is not good. Most of them are credits that are going to disappear. And this is not, I don't think I have the whole list here, but I'm going to give you just a few. Well, the one credit that's going to increase is the child tax credit, which was scheduled for this year to be $2,000 per child. Now it's going to be $2,200 per child. So that's a 10% increase in that credit. And that starts in 2025. And it's going to have inflation adjustment after 2025. There'll be some extra requirements that they're mentioning. I'm not sure why they're mentioning, because they're saying that a social security number will be required for the children and one of the parents. But I think that they already have that on the return. So I'm not sure why they're mentioning that. Maybe there's going to be an extra form that you have to fill out. So at any rate, so that'll be a slight benefit. Now, here's the long list of all of the credits that are repealed, and I'll give you the dates that they're repealed. So the previously owned clean vehicle credit. So that's if you buy a used car that qualifies as a clean vehicle. I think that could be electric or some other clean vehicle, hydrogen. That's repealed effective September 30th of this year. The clean vehicle credit, that's for the new one, that's also repealed September 30th of this year. The qualified commercial clean vehicle credit, repealed September 30th this year. The alternative fuel vehicle refueling property credit, that's repealed for if a car is placed in service after June 30th of next year. That's not a credit that I've seen real often on clients' returns. The energy efficient home improvement credit is repealed at the end of this year. The residential clean energy credit for solar is repealed at the end of this year. That's a credit that many of you have taken advantage of. That's typically been 30% and was really a big reason that many people put solar in. So this is going to be really dramatic for what happens in the solar how for homes is going to really drop off dramatically. The other credits that repealed, the new energy efficient home credit is repealed as of June 30th next year. And the clean electricity investment credit is going to, which is repealed for, this begins after July 4th of next year, 2026. The credits are repealed for wind and solar technology facilities. So there are a few other credits, but these are the ones that, mainly I thought, people may be interested in if you're thinking about putting solar on your house, or if you're thinking about buying an electric car. These are definitely going to be things that are going to impact you, and you want to, check closely before you make a move based on thinking you're going to get a credit. Okay, and then I think the other one that's here, there's another new deduction, which is if you this credit's going to this is a deduction. It's going to start actually in 2025 and run through 2028 on loans that you receive, and it could be a new loan to purchase a car or refinancing a car after 2024. So something that you've done this year, you get to deduct up to $10,000 per year of the interest you pay on that loan. However, there's always a however. If your adjusted gross income is over 100,000, so fairly low for the Bay Area, or you're married filing joint at 200,000, this is going to phase out. So, and I'm not sure how quickly, but probably, if you're about 40 or 50,000 above those numbers, you won't get to take this deduction. So if you're saying, whoopee, I can go buy a car and deduct it, but you make 200,000 or 300,000 a year, you're probably not going to get benefit from this. Before I do the qualified small business stock and the qualified opportunity zone changes, I just want to mention a few, two or three other things that were changed that you might be interested in. They didn't change the $750,000 mortgage interest limitation, but they did change mortgage interest premiums that you pay. Like if you have an FHA loan and you're being charged those mortgage insurance premiums, that's going to be treated as acquisition indebtedness for purposes of the $750,000 limitation. They made a change to exclude educator expenses from the definition of the 2% miscellaneous itemized deduction. I got to dig further into that because I have a few clients I know that do take that. I'm not sure exactly how that's going to play out. And for those of you who typically have gambling winnings and losses, starting next year, you're only going to be able to use 90% of the losses that you have to offset the gain. So unless you have, substantially more losses than gains, you may end up paying tax on some of your gambling winnings. Okay, so let's go. I want to go back to what was on the first slide there of the two and talk about qualified small business stock. This is fairly complicated, and I know it doesn't affect a large number of our clients, but we do have some that own qualified small business stock. So the significant benefit, and I'm going to define what that is for people that own qualified small business stock, it's you're going to have your benefits that they had. Some are going to be enhanced, and others are going to be reduced based on this bill. So, a qualified small business stock company has to be a domestic USC corporation. Okay, so it can't be a foreign corporation, and it can't be a subchapter S corporation. Under the old law, the previous law, when the company is issuing its initial stock, it could not have more than $75 million of assets, and the new law reduces that to 50 million. So it has to be even a little bit smaller company than what it used to be. It must also have at least 80% of the assets that it owns that are actively engaged in a qualified trader business. And the qualified trader business is one that does not involve personal services, financial activities, real estate, and some natural resource and hospitality businesses. So those are primarily service businesses, do not qualify, but other businesses typically do. People who are eligible, if they own stock in this type of company, they must have purchased their stock directly from the company. They're not. You're not allowed to get this treatment on your taxes if you bought it from another person. It has to be directly from the company. The shareholder must also be an individual, a trust, or a state. No corporate shareholders are eligible for this treatment. Under the old rules, the stock that you owned, if you held it for 5 years, it would be eligible to fully exclude the capital gains that you receive from it. So this is a huge benefit if you own this kind of stock. The new law says for stock that's issued after July 4th of this year, that you're actually eligible. If you hold it just 3 years, they'll let you exclude 50% of the gain. And if you hold it 4 years, you can exclude 75% of the gain. And if you hold it 5 years, you still get the full exclusion. Okay, but in order to use this exclusion, you have to be selling or exchanging the stock in an actual taxable transaction. So in other words, you're reporting it as a taxable sale on your return, and then you're saying, oh, but by the way, this is qualified small business stock, so I'm eligible for some exclusions. The limit of it on exclusion of gains is the greater of 5 million. I'm not sorry, 15 million, excuse me, for stock that's acquired after July 4th this year, or 10 times the taxpayer's adjusted basis in the stock. So it's a pretty large amount of exclusions. So again, I know that this doesn't impact a lot of you that are who are listening to the webinar, but if it does and you have more questions, just call our office and we'll go deeper with you on it. So if Aaron can just flip to the next slide, which had the QOZs, that's the qualified opportunity zone properties. So the purpose of the qualified opportunity zone was to give tax incentives to investors to buy and improve properties that were in low income areas throughout the country. And this law that law was implemented back with the TJC again back in 2017. So it's been around for about 8 years, and a lot of companies put together programs so individuals could participate in these. And what you're doing is that you're deferring gains that you have from a property sale, and you had to reinvest in the qualified opportunity fund within 180 days. That's now being changed under the new law to you now can reinvest from your exchange out of something that you had a gain on with a rolling 5-year deferral. That's how they describe it. Again, I have to go a little deeper to really understand what that exactly means, but it's definitely a longer time period that you have to do the deferral from a gain that you have on a property sale and roll that money into a qualified opportunity zone property. You also get, if you invest in these, and you get a 10% basis increase is granted after 5 years that you're invested, and an additional 5% increase after you've been invested for 7 years. So you're not only deferring your gain in, so that's going to mean you start with a little bit lower basis because all the gains that you deferred lower the basis. But if you hold it for a long time, you're going to get these basis increases. But the other thing is that you're required, if you have one of these properties, that you have to do significant investment in the property that was bought, typically exceeding 100% of the adjusted basis of the property. So not the cost of the property. The adjusted basis is going to be lower based on, how much you deferred from your previous gain. So under the new laws, they're changing some of these things, and I'm just going to give you briefly, in essence, what the changes are and what they're going to impact. And the changes are going to basically make it more targeted to underserved communities. So they're going to try to make sure that definitely the money's not being used, in an area that's, really in a nice area of town, but it was close enough to a bad area of town. So they're trying to tighten up some of those rules. They introduced a new category called rural opportunity zones, where they're going to require or they're going to give you a larger basis increase of, instead of 10%, and then an additional let's see, let me see, I'm mixing these things up. There's so many numbers. It was 10% and then 5% after 7 years. Now they're going to give you a 30% basis increase, and instead of requiring that you would improve the property by at least 100% of the adjusted cost basis, it only has to be improved by 50% of the adjusted cost basis. So the reasoning here is that they really want to have people be buying property in rural, undeveloped areas and building things and improving, buying things there and improving things there, so the rural areas are not being left out on this. And so those are the main gist of the changes for the opportunity zone rules. So I know that was a lot of material, and I hope I covered things that were of interest to most of you. But if you do have questions, you can send it in the chat. We might be able to answer them now, or if not, we can get back to you with the answers.